Welcome to this explainer. Okay, think about your company's finances for just a second. You wouldn't even dream of running a successful business without tracking your revenue, your expenses, your profit margins, right? You keep a really strict financial ledger. Well, today we're talking about a totally different kind of ledger, but one that is becoming just as absolutely critical to your bottom line. We're talking about carbon accounting. Because tracking your carbon footprint, it is exactly like keeping a strict financial ledger for your business. It requires that exact same level of discipline, the same meticulous attention to detail, and honestly, it yields massive strategic advantages when you do it correctly. Let's get into it. So, the big question, are you ready for net zero? It's a huge buzzword right now, isn't it? Everyone is talking about net zero targets, carbon neutrality, going totally green. Okay, let's dive into this, because we need to instantly dispel a very common and kind of dangerous myth right off the bat. You cannot achieve net zero simply by planting a few trees on the weekend. Look, a tree plantation drive is wonderful for the community and the local environment, for sure. But if your factory is still out there burning undocumented tons of coal or diesel, you aren't anywhere close to true net zero. True climate readiness? It requires hard data, not just good intentions. And that brings us to the core truth of this whole thing. A company cannot credibly reduce emissions until it actually knows where those emissions are coming from. Think back to that financial budget analogy. If you have zero clue where your money is going, how can you possibly cut costs? You literally can't. The exact same logic applies to greenhouse gases. You absolutely cannot manage what you do not accurately track. Before any company can start talking about carbon credits or making these flashy ESG claims, it really must understand its baseline footprint. So, to help us get to that baseline, here is our roadmap. First, we'll be defining carbon accounting. Number 2, the 3 scopes of emissions. 3, the real-world business impact. 4, practical data templates. And finally, common mistakes to avoid. If you're an MSME owner, a CSR professional, or an ESG consultant, I promise you, this is going to be a direct, highly practical, and totally jargon-free guide.
All right, moving right into part 1, defining carbon accounting.
Let's lay the groundwork. Carbon accounting is basically the process of measuring greenhouse gas, or GHG, emissions linked to a business. To actually do this, we use the GHG protocol. This is effectively the universally accepted accounting principles for carbon. It provides the standard, global framework used to categorize and measure these emissions. So what that means is a company in India is tracking things the exact same way as a company in Germany or Japan. It keeps everyone on the exact same page. Let's move to section 2 and see how this builds into the 3 scopes. The GHG protocol actually divides your emissions into 3 specific layers, which they call scopes. And this is all based on how much direct control you have over them. First up is scope 1. These are your direct emissions. They come from sources that are directly owned or controlled by your company. To make this super concrete, just imagine walking right onto your factory floor. Scope 1 is the fuel you are physically burning on site. So based on our sources, this includes the diesel used in your boiler, the LPG used for process heating, furnace oil, natural gas, or coal. It also includes the fuel burned by any company-owned vehicles or maybe your captive diesel generators. Basically, if your company owns the equipment and burns the fuel, well, that exhaust pipe is your scope 1. Next, we have scope 2. These are the indirect emissions from purchased electricity, steam, heat, or cooling. What's really interesting about this category is just how actionable it is. Think about it. You aren't burning coal on your property to make this electricity. The power plant is doing that miles and miles away. But because you are the one buying and using that power, those indirect emissions, they belong to you. And for so many Indian MSMEs, keeping track of purchased grid electricity is an incredibly measurable and absolutely essential starting point for their carbon ledger. You don't need some complicated scientific instrument to track this. You literally just need to look at your monthly electricity bill. Finally, we reached scope 3. Now, this covers all the other indirect emissions generated throughout your entire value chain. It's like the ripple effect of your business. It includes upstream activities, like the carbon footprint of the raw materials you're purchasing, or outsourced transport bringing those materials directly to you. But it also includes downstream activities, things like packaging, waste disposal, product use, and even how your employees are commuting to work every day. Scope 3 is almost always the largest category for any business, but honestly, it's also the hardest to track, mainly because you're relying on data from your external suppliers and partners. Which brings us to section 3, the business impact. So, the crucial point is this. Now that we know what we're tracking across those 3 scopes, we really have to ask why. Why should a busy MSME owner care about this stuff right now? Well, carbon accounting is no longer just some vanity project for massive global corporations. It is hitting the mid-market right now. Tracking your scopes is the absolute foundation for any ESG reporting. But going beyond that, corporate buyers are now actively sending data requests to their suppliers. Why? Because your Scope 1 and 2 emissions actually become their Scope 3. So if you want to keep those big corporate contracts, you need this data. Furthermore, lenders are starting to require this information to unlock green finance and favorable loan rates. And if you're looking to sell internationally, this carbon data is fast becoming a strict requirement for export readiness. Your future revenue seriously depends on this ledger. Okay, let's get into the how-to with Section 4, Practical Data Templates. So how do we actually do this without getting completely overwhelmed? Well, you don't need complex software on day one. You can start with a minimum data template right in a simple spreadsheet. And this brilliantly illustrates the point. Just consider these specific data points: month, electricity in units, diesel in liters, LPG in kilograms, transport in kilometers, waste in kilograms. The crucial first step is simply recording your fuel and electricity from your actual physical invoices every single month. Just get the raw data down in one place. Boom. That is the beginning of your carbon ledger. But, and this is a big but, there are rules for managing this data accurately. As you build that spreadsheet, you absolutely must keep your bills and invoices as proof. When you eventually convert those liters of diesel or units of electricity into actual carbon metrics, you must use recognized emission factors, and you've got to clearly state the source and the year of the factor you used. And perhaps most importantly, do not quietly mix estimates with actuals. Look, if you don't have the exact invoice for something and you have to make an educated guess, that's perfectly okay, but you must explicitly label it as an estimate. Transparency is literally the entire point of this exercise. Moving on to our final section, number 5, common mistakes. To protect you and your business from embarrassing or potentially very costly compliance and reporting pitfalls, here is what you absolutely must not do. We kind of already covered the first one. Do not claim carbon neutrality just because you planted some trees. Second, do not count carbon credits before verifying the underlying project. If the project is fake, your claim is fake. Third, please don't ignore electricity. It's the easiest Scope 2 data to collect, so there's really no excuse. Fourth, and listen closely here, do not calculate your Scope 3 emissions using wild guesses when supplier data is missing. Using unlabeled guesses is totally unacceptable. If you are missing data, you must clearly label it as estimated. Finally, do not compare two companies unless their boundary and calculation methods are exactly the same. It's like comparing apples to bicycles. It just doesn't work. We've covered the definitions, the 3 scopes, the profound business impacts, the practical templates, and the critical mistakes to avoid. Now, the knowledge is in your hands, so I want to leave you with this final provocative question. How will you start tracking your carbon ledger today? Are you going to go pull this month's electricity and diesel bills right now? Remember, you cannot manage what you do not measure. Begin your physical tracking journey immediately. Build that ledger and secure your business's future in the green economy. Thank you so much for joining me for this explainer, and I'll catch you in the next one.